Good morning, and welcome to the Energy Prospectus Group webinar hosted by Solaris Resources. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here is Dan Steffens, who will introduce today's speaker.
Welcome everybody, and thank you for attending our webinar. I'm really pleased to share with you another very promising copper company today. Solaris Resources is a mining company with headquarters in Vancouver, Canada. They are advancing 5 copper and gold projects in Central and South America. They're currently focused on developing their significant high-grade copper discovery in Ecuador. Our speaker today is Daniel Earl. He is the company's president and CEO. He has over 17 years of experience in the mining sector and capital markets, covering projects ranging from early stage exploration through feasibility studies and engineering to production. Prior to joining Solaris in November of 2019, he was a vice president director at TD Securities, where he covered the mining sector for over 12 years and established himself as a thought leader in the space. Prior to joining TD Securities in 2007, Mr. Earl was a senior executive with a number of Canadian and U.S. publicly traded mineral exploration and mining companies. He sits on the board of directors of Augusta Gold Corp and is a graduate of the mineral engineering program at the University of Toronto. During the presentation, if you have any questions, please post them to the chat box and we'll read them when I come back on Q&A. But now I'm going to turn it over to Daniel Earl, and I will return for Q&A after his presentation. It's all yours, Daniel.
Dan, thanks so much for the introduction. I'm really excited to be here. And hello to everyone in the webinar and online, and eventually, when it's reposted on YouTube, hello to you as well. I thought the way I'd begin this is just providing some very brief remarks, kind of a summary of the outlook for copper, which kind of sets the context for what I'll tell you about Solaris Resources. Then I'll get into Solaris. Again, keep it at a high level. And then if there are any questions that come up, we can deal with those in the Q&A portion. So with that, let me start on copper. The way that I would describe kind of my outlook for copper is really in 2 parts, kind of a tale of 2 stories, if you will. The first is kind of the market that we're going to have in the near term, and that I think is going to continue to be a firm market, where just at the moment, over the next month or so, we may see some inventory builds, but this is really just a function of the Lunar New Year in China. China represents about half of current copper demand. And the Lunar New Year is their holiday period. Obviously, it shuts down about 2/3 of their consumption. And that's why I think we might see a bit of an inventory build. But once we get that behind us, then we're going to be back into deficits. And we'll have deficits across this year. We'll have more of a balanced market next year, and then back into deficits in 2024. And this would be sort of the consensus view that you'll find out there from whoever the forecaster that you're following, Goldman Sachs, maybe in the US. Here in Canada, BMO Capital Markets would probably be the most significant player. And that's roughly what they'd be presenting to you as well. And so in my mind, that's basically a well-supported market here in sort of a $4 to $6 range. Okay, the fireworks in copper really start when we get past peak copper supply. Okay, and this is when the structural deficits really start opening up. So now we're looking out late 2024 and then beyond 2025, certainly large deficits, and then they just grow out into the future. And so if you fast forward to that point, we'll be looking at a forward view then where those deficits really start to approach critical levels and then just keep on going. And this is driven by the normal business cycle, so the normal demand profile for copper. And then superimposed on top of that, you've got the global mega trends, if you will, of electrification and decarbonization. And at that point, when we get out to the middle of the decade, those are going to be very well advanced. Okay, and so then copper is no longer, dominated by China at that point. These are a global trends, so it's really a global story in terms of this decarbonization and electrify everything drive. where you've got the demand split, then split, a third between the major economic centers, China, the US, and Europe globally. And so a much more stable and sustainable kind of underpinning to the structural bull market that we're going to have than we've had in prior copper price cycles. Okay, so I think in those years, really in the second half of this decade, this is when the market really is going to break out and become, kind of unanchored by the traditional sort of constraints on the copper supply. So if you're looking at the copper market, you may be thinking that, as a metal market, it should be constrained by, some percentile in the cost curve. Normally in copper, we look at the 90th percentile. But by the time we get to the middle of this decade, it's going to be an entirely different, that model will be insufficient, and we'll be looking at an entirely different pricing mechanism for the market. And this will be, when we've got sort of a scramble for supply, and the pricing mechanism will have to be incentivizing new supply. Okay, so this is sort of a security of supply type market, or incentive pricing type market. And if you want an example of this, think of lithium prices last year. Many of you will be well familiar with the bull market that we had for lithium. That was a incentive pricing market where the market went up, 450% to try and bring in new supply. And then you saw the corresponding reaction from industry with a flurry of kind of transactions to try and secure these projects, to bring them in to fill in the gap. Okay, and so this would be a period starting middle of the decade and then looking out beyond, where you're going to see much, much higher copper prices. Certainly a minimum range would be in the $6 to $8 per pound, but then peak pricing, obviously you're going to be looking at kind of double digit prices for the copper supply. And that's really what's going to be required to balance out these supply deficits that we forecast. Exactly how it's going to happen, I'm not sure, because I just don't see the projects in the global inventory. The discoveries haven't been made in this industry over the last decade to feed in. The investment just hasn't been there. So how it happens, I don't know, but certainly it's going to require much, much higher copper prices in the future. Okay, with that on copper, and we can certainly turn back to that in the Q&A. I can speak about the copper market, the industry dynamics around it, and M&A cycle and so on for an hour. But I've got to get into Solaris. This is the story that I'm the most excited to tell. And it's really focused around our Solaris Discovery in Ecuador. And this is an absolutely world-class discovery. It's the only project anywhere in industry that you're going to see that's serving up 1,000-meter long intervals. So these would be, over 3,000-foot long intervals of 1% copper mineralization right from surface, with the very highest grades starting right at surface or very close to surface, with the project being adjacent to primary infrastructure and in a viable jurisdiction that's really welcoming investment. When I say across the industry, this being the only one in industry, that's not just juniors, that's including seniors. There's no one else who has anything like this that's turning out these sorts of results. Okay, and it's coming at a time where and even if the copper price market hasn't reflected this, as we talked about, the industry, so the copper industry is very much looking at those structural deficits that I talked about, which are locked in because of the long lead cycle on copper. It's not like oil, say a fracking project or something, or an oil project, where you're looking at a period of few years. Copper's long cycle, 7 to 10 to 12 years, with the increasing restrictions around DSG to bring these projects in. So these deficits are locked in, and the industry is looking ahead to these and is absolutely desperate to start adding those projects that can be brought online, viable large-scale projects that can be brought online. Okay, and there's just a total dearth of options there in the pipeline. The brownfield options were exhausted. The major brownfield options were exhausted in the prior cycle. That's ultimately how the supply deficits of the prior cycle, which was the China-dominated cycle, beginning in the mid-2000s, and then running into, say, the mid-2010s or middle of the last decade, driven by, the rapid China growth, urbanization, industrialization in that country. And that led to a quadrupling of the copper price that was ultimately to fill in about a 4 million ton supply deficit. And as I said, it was the major brownfield projects, the top 10 in the global copper industry, represents about 25% of supply. Those projects were expanded and expanded again to ultimately fill that in. That's behind us. You can't do that any longer. Those projects are actually starting to roll over in the next few years. And so it's going to have to be about greenfield, new projects. And we just don't see the inventory of those projects. We just haven't had the investment. We haven't even had the discoveries, which would fill that in. So with this project, with this very special project that we've had, we've been very clear from the beginning of this story in communicating what our objectives are. Two simple objectives. The first, establish the world-class credentials of the project. Okay, so we set a goal. What defines world-class in the copper industry is a 1 billion ton open pit. So we set a goal. We're going to establish this project as a world-class project by defining at least 1 billion tons. Emphasis on at least. In an open pit in the central zone. You don't want underground in copper, you want open pits, so you can do it at big scale. Okay, so 1 billion ton open pit in our central discovery. And this is a crucial difference in this project versus some of the other projects you might see, with a high grade starter pit. So the highest grades right at surface that can be mined first. So you front end load the production, you front end load the cash flow, and you hit all those financial metrics that you want to hit with a project. High internal rate of return, high net asset value, high EBITDA margins across the first few years of production, et cetera. Okay, so that resource, we're going to deliver that in the coming weeks. That'll be out by the end of Q1, is what we've signaled to the market. And that's going to be a major catalyst in the evolution of this story. Okay, and I'm going to speak more about the implications of that resource later in the presentation. But that's the first deliverable. The second one is to demonstrate that we've got multiple times growth potential beyond that resource at central. So deliver the central resource plus 1 billion tons with the high-grade starter pit, but then to show through our discovery drilling that we've got potential to expand that multiple times in the adjacent and nearby discoveries that we have on this property. Okay, and so we've made discoveries on the first holes that we've drilled. When we've stepped out beyond central, we've made discoveries on the very first holes that have ever been drilled at our west deposit, which was discovered back in February of last year, at our east deposit that was discovered in July of last year, and now just a couple weeks ago, undoubtedly the largest of these discoveries, we made it our south deposit, again, on the very first holes that have ever been drilled there. And we've got more coming in terms of targets that we're going to drill. I'm going to speak to that. But this is a very simple, clear strategy to establish the world-class potential of this project as being, I view it as being the best exploration and development opportunity on the board. And then to do it in one of the only jurisdictions globally that is not just through its words, but actually through actions, improving itself from a regulatory and a fiscal perspective to incentivize these new investments in the mining sector. So streamlining permitting, cutting taxes in an effort to rapidly build out its mining sector. Okay, and we're putting our money where our mouth is. Okay, so I'm all in terms of my personal investment in this company, Solaris Resources. It pales insignificant in terms of the magnitude, but not the meaning, to our executive chairman, Richard Wark. He's invested nearly $130 million of cash in this company. Okay, and that includes, that's not just, that's not vending in an asset that was valued at some portion of that, or buying cheap shares that have been revalued. That's $130 million of cash that he's invested, including recent purchases in the market. So whenever a block comes available, you'll see our executive chairman is apt to take that down if he can. All right, so large investment. In terms of the management here of this company, it's managed by the Augusta Group, which is a Vancouver-based common management group. We have the same goal with all of our companies, and we absolutely stick to our knitting, which is surfacing the value through the early stages of project development, so exploration, development, and then crystallizing it through an exit transaction. So selling it on to one of the major producers to develop the project and ultimately produce from it. And this is just what we do. I mean, this is our specialization. We've got a track record of over $4.5 billion of exit transaction last decade. entirely within this niche of exploration and development. So this would include companies like Ventana Gold. This is a gold project in Colombia. When Colombia opened up its mining sector, quickly came in, made a discovery of the low-hanging fruit. This is similar to what we're now doing in Ecuador. We built up the value of it, sold it for $1.6 billion in 2011. Augusta Resource Corp, this is a copper asset we had in Arizona. We sold that for $670 million in 2014. Newcastle Gold, this was a gold development asset that we had in California. We vended that in to co-found what is now Equinox Gold, which is something well over $1 billion mid-tier gold producer. That asset, which was a development asset for us, is now in production. And then most recently, we sold Arizona Mining. This is a polymetallic asset, zinc, lead, silver, and so on. In Arizona, obviously, we sold that for $2.1 billion to a company called South32, an Australian company, in 2018. And that's gone on to double and triple in size for South32. So an excellent transaction for them. In terms of the capital structure of the company, it's very, very well financed, as you'd imagine. We've got a following. We've got, for our purposes, unlimited access to capital. This company currently has about $47 million of cash on its balance sheet as of the last reporting period at the end of Q3. And that is with the very heavy lifting relative to the strategy I laid out to you. So the resource drilling that we need to do to establish those world-class credentials that I described for our central zone, that's with that heavy lift behind us. Okay, so we're now very well funded when we look forward relative to what we need to do to see out the rest of our strategy here. This is all focused around, the discovery drilling, which is high impact, but in terms of what it means and what it demonstrates for the project, in terms of the growth potential and demonstrating that multiple times growth potential, but it's low in terms of the expenditure that we actually need to commit to it. And likewise, the technical programs around demonstrating the production scale, the dynamics around production, the details of the site layout and the infrastructure and all the rest of it, those are, rounding errors in comparison to the cost of drilling for a company like this. So very well funded in terms of just the cash we have on the balance sheet. But then, of course, we've got warrants that are in the money, and these are substantially held by, management itself. And then also our strategic supporters who've been strong backers of the company. And the strategic supporter set here with this company, if these aren't familiar names to you, Ross Beatty, Lucas Lundin, and Richard Warwick, our executive chairman, these are major players in the mining sector. They have track records each individually of generating billions of dollars of shareholder returns for investors across their careers. So this is a real who's who of the mining sector that we consider as our strategic supporters in this company. Okay, I'll just turn to Ecuador, which is where our flagship Warintza project is located. This is it's really important to understand. It's a relatively new jurisdiction for the mining sector, but it's quickly becoming, through the actions they're taking, one of the premier jurisdictions for new investment. And it's really bucking the global trend that we see when we look out across the global mining landscape. We see things getting much more difficult from a tax and fiscal perspective, where taxes are going through the roof to try and pay for all the social and crisis spending during the pandemic in these countries. But then also from a regulatory perspective, with the increasing emphasis on ESG, environment, social, et cetera, it's just becoming a more difficult playing board for the mining sector globally. But Ecuador is going the opposite direction. Ecuador is becoming much more favorable for mining. And this really began in 2014. This was a country that depended heavily on revenues from its oil exports. As you guys well know, 2014, the oil price collapsed. And so the country looked to the mining sector. It's got tremendous geology in this country that had never been tapped because they've been relying on oil. It turned to the mining sector and began to open up the mining sector in the country at that time, and then encourage the growth of the sector by bringing in reforms to make it a more attractive place to invest. So this included obviously cutting taxes, cutting royalties, but then on the regulatory side, streamlining permitting so companies could actually come in and move these projects forward. And under the new president, Guillermo Lasso, he was elected in April to a 4-year term. And that'll turn into an 8-year term if he maintains what is a very high level of popularity. This is really intensified. This drive to kind of, implement these reforms and accelerate this investment in the sector has intensified under Guillermo Lasso. And Lasso's a true conservative. This is someone who came from very humble beginnings and then made himself a very wealthy, successful entrepreneur, building out a banking empire in the country before he turned to politics. Okay, and so he's a dyed-in-the-wool conservative and enthusiast for the power of the private sector to drive, successful outcomes in his country. And that's what he wants to deliver for the country at large now. That's the motivation behind his turn to politics. And he's got a very high degree of credibility. You can see that internationally in the signal that you get through the bond sector, where Ecuador's bonds were the best performing emerging market credit globally last year. That's the signal that you're getting from, international investors when they assess the direction of the country under Guillermo Lasso. You see the same thing internally in terms of his polling levels, where he's polling at record-setting, historic levels of popularity for a new president in the country. And his agenda is really clear. It's all about the economic revitalization of the country. This is going to happen through private investment. This isn't going to happen through government spending. And the key pillar is going to be the growth of the mining sector. Okay, so natural resources as a whole, doubling oil production, but then the mining sector is the easy, low-hanging fruit for this government. And he wants to see Ecuador become a major exporting country in the way that you have with Chile and Peru, the world's #1 and #2 copper producers currently. Okay, so they're calling out for this to be the decade of mining in Ecuador, billions and billions of dollars of investment to build out this sector. But it's not just words, okay? This is reflected also in the action that they're taking. And so we just saw the Lasso administration implement the mining action plan under the mining decree that Lasso himself signed at a meeting I attended back in August. And this is specific steps with a timeline to improve and incentivize the growth of this sector. And this includes, you haven't seen it reported in the press yet if you've been following along with Ecuador, because the agreements are still to be signed. But this includes the next round of fiscal incentives for the mining sector. So this is eliminating import taxes, which the sector relies on for equipment, consumables, et cetera, services even. Eliminating remittance taxes. So this is repatriating dividends from mining operations out of the country, getting rid of those. And then a further 5% reduction in income taxes for new mining investments in the country. And all of this together with the other reforms on the regulatory side, you can lock in with security of title, security of law, tax and fiscal stability in investor protection agreements. They're then subject to international arbitration. Okay, and we're going to have our submission in under this new investor protection agreement scheme. In fact, we just submitted it last week. We'll get the response in the next couple of weeks from the government, and then about a 4 to 6 month timeline before that's approved. Okay, so that's Ecuador. Ecuador is going in the right direction. What's important, though, is to take a broader view. You have to look at the rest of the industry to understand what's happening in Ecuador in context. What it means to industry. And that's when you look at, what's going on in the world's #1 and #2 copper producers, Chile and Peru. Okay, so in Chile, which is representing about a quarter, more than a quarter, almost a third of the world's supply at the moment. You've got a country that's going in a difficult direction. So they just elected a new president, Gabriel Boric, in December. He's a far left student activist, a 35-year-old new president, comes from being a student activist, and he was elected in a coalition that represents everything from the far left through the Communist Party in Chile. This is in the world's #1 copper producer. And he comes to power in March, but already the taxes are going up. So this is something that predates him. through action that's been taken in the Congress and the Senate. And they're going to go up a lot more when he gets into power. But the Senate just last week approved a new set of taxes, including a 3% royalty and up to 40% tax on operating. These are new taxes, up to 40% tax on operating profits, which will take the tax rate on the copper industry in that country on large scale operations up to anywhere to 70%. In that, so somewhere from 55 to 70% in that jurisdiction, which is going to be devastating. And then we'll see what Boris does from there. And then restrictions, of course, it's not just the taxes, it's also the restrictions that are coming in. These are going to come in hot and heavy. We'll see another round with the new constitution that comes next year, but already we've seen major mines have been impacted, like BHP, the world's largest mining company. They actually had to shut down their Cerro Colorado mine late last year and then again early this year due to some of the restrictions around using water in that country. So Chile, the world's #1 copper producer, it's going in a very difficult direction. The world's #2, Peru, is even worse. This is in a true crisis situation in Peru. We're talking about nearly 20% of the world's copper supply here. In Peru, they elected in Pedro Castillo, and this would have been in June of last year, certainly far left, but the more apt way to describe him is as a community activist. And obviously he wants to implement the same taxes as he sees in Chile. He said that directly, so that's something that's coming in the future. But the damage has been more immediate in Peru's mining sector, where this community activist who's come to power has really inflamed tensions in the communities. And this has actually led to the shutdown of some of the biggest mines in the country. Antamina, Antapaccay, Las Bambas. These are the biggest mines in the country that have actually been shut down for various periods. Bambas is just shut down again after being shut down, late last year. This is going to have an impact directly on the copper market and drive further deficits that you'll see this year. But then obviously for the projects that are being contemplated that are, post-engineering and waiting to be sanctioned, these are projects like Yanacocha sulfides. This would be or Congo, which would be Newmont projects, the world's largest gold producer you guys would be familiar with, or Tia Maria, Southern Copper's major copper project. These are being canceled. The announcements have gone out. These have been, deferred or canceled for the time being. And then certainly with the next round of project, there are major question marks. Projects like Toromocho, it's a Chinese project, or Hikira from First Quantum, La Granja from Rio Tinto, Las Chances, Michiquila, this next round of projects. These are all going to be frozen until the turmoil resolves itself or doesn't resolve itself in Peru, in which case they'd be canceled. So these are the two major jurisdictions in copper. That's why I talk about those. We could go on and on. This is really a global phenomenon, which is impacting on the mining sector. And remember, these are projects, these are jurisdictions that are being relied upon. These are projects, all of the ones that I mentioned are already built into supply forecasts going forward. So, and even that isn't enough to set off, to fill in these structural deficits that we've been talking about. So you start taking these out of the profile, which is assumed, then you start growing those even faster. You bring forward those structural deficits that I've talked about, you make them wider, and you require a higher copper price to find alternatives. Okay, so that's the impact on the copper market. But think also about industry. The industry dynamics are even more important to a company like Solaris, given what our goal is for this company. All that uncertainty that I just talked about, that causes a reassessment of spending plans. I think that reassessment ultimately morphs into a realignment, okay, of capital out of those jurisdictions and into jurisdictions that are going the right way, like Ecuador, and specifically our project. That's a real benefit. That's why I say all this turmoil and the positive evolution in Ecuador is coming at the perfect time for us. We couldn't have asked for a more favorable backdrop for this story. Okay, let me get into the project itself now. This is located in what is a naturally low-cost mining district in southeastern Ecuador, both from a cost to build these projects from a CapEx perspective, but then also a cost to operate these projects as well. The largest mine in the country, it's called Mirador. It's operated by the Chinese. It's about 40 kilometers down the highway from us. And then there's a large gold mine to the south of that called Fruta del Norte, which you may be familiar with. It's operated by Lundin Gold. It's their flagship asset. And the Mirador mine, that's comparable to what we would have in our central zone. Okay, and it's now in production. It just went into production in the last 2 years. It's already a very low unit cost mine. Okay, so their economic cutoff grade would be right around 0.1% copper. Okay, so when you look at our grades, keep in mind a break even would be around 0.1% copper at Mirador, something like $10 a ton. If you want to think of it in terms of dollars, it'd be about $10 a ton. If you look at our starter pit, okay, and this is based on historic drilling, very shallow, limited historic drilling from 20 years ago, it's already at 0.7% copper, and we've had a lot of better results in the more recent drilling that we've been doing. So it's at 7 times what is, an economic cutoff grade just down the highway from us, to put things in, to put our results in a bit of, perspective for you. And of course, we're benefiting from all the same advantages as them. I mean, these are, the connection to the highway. So this is to get all your equipment and supplies in, get your product out to the Pacific ports where you can send it on to the smelters in Asia. This is the power grid that runs roughly along that highway. Ecuador, if you don't know, is a regional powerhouse. They're actually generating excess power. They export that out to the neighbors. And this is 2/3 hydroelectric power, okay, which means it's cheap, but then also that it's clean, which is increasingly important for Western mining companies who are being graded on their emissions. Power is the most significant input in terms of driving emissions in the mining sector. So that's really important. And actually, just a further note on that aspect of the potential with this project, the largest hydroelectric project in the country, Santiago, which is out for tender. The tender is going to be awarded in the next 180 days. This is a $3 billion project. It'll generate 2,400 megawatts of hydroelectric power. Actually, it joins our project directly to the north. And this is a major industrial development. It's fully permitted, fully environmentally sanctioned. It's going to be going ahead within the time frame that we're bringing this project. That this project eventually, Warintza goes to production, and Warintza will use about 10% of the power from that project. Okay, that's our next door neighbor here. Okay, so the highway, the power grid with more coming. It's at low elevation. This is something maybe isn't so obvious. This project's entirely below 2,000 feet or 2,000 meters. So that'd be 6,000 feet in elevation. So no problem in terms of elevation. The projects that we're competing with in Chile and Peru, these are increasingly higher in elevation. So the major mines of the industry are above 3,000 meters. The more recent mines that are coming online just in the last 10 years are at 4,000 meters. The next generation are above, 5,000 meters. Some of these exploration and greenfield type projects are above 5,000 meters. 5,000 meters elevation, you can barely breathe. Okay, and that has a direct impact on cost. So the low elevation, low cost labor, because Ecuador hasn't built out its mining sector yet. Cost of labor in Ecuador is about half of what it is in Chile. It's a significant discount to what it is in Peru. And then the most important is just the water. We've got freely available fresh water in abundance in this mining district. Okay, and fresh water is at least $1 billion capex item. If you don't have fresh water, or you're being restricted from using fresh water the way that you would be in Chile. So even existing operations in Chile are being weaned off fresh water because it's sensitive. They're operating in an arid environment. Local populations want to save the water for themselves, so it's low cost for themselves and farmers and so on. And so even existing operations are being weaned off water. This has led to shutdowns and production, limited the ability to expand assets in Chile. In the future, all new projects in Chile are going to require their own water source, which means desalination at the coast, and then pumping and pipelines running hundreds of kilometers inland to get it to these mines up at high elevation. That's at least $1 billion of CapEx, and it has a significant impact on OpEx. And mine economics are simple. If you're spending $1 billion extra on CapEx, your project is worth $1 billion less. And vice versa. If you save $1 billion, your project's worth $1 billion more right out of the gate. Like just it's really that simple. But then obviously in this district, we're benefiting on the OpEx side as well, as you can see there. Okay, in terms of exploration that we've been doing, this slide really illustrates those two objectives that I set out for you in my introductory remarks. If you recall, the first thing was just establishing the world-class credentials of the project. So doing this through establishing a resource of at least 1 billion tons. This is just in our central deposit, at least 1 billion tons with a high-grade starter pit. So within that 1 billion tons, an area of 150, 200 million tons, where we've got grades, which are the driver of revenue, that are at least 50% higher than the overall grade. Okay, so we can bring forward the copper production, we can bring forward the high grades, the high margins, get those really high cash flows in the early years of this project's life to get that rapid capital payback. The higher our high margins across those years, and whatever other financial metrics you want to grade the project on. So billion tons in an open pit, then with a high grade starter pit. That was the first objective. The second objective is just to demonstrate the growth potential beyond that. So focusing on the resource drilling, that first objective, this is in the blow up image on the right. And what you see here is basically all the drilling that we've done in support of that resource in our central deposit. And this drilling is now done. We've done more than enough drilling to get across, the threshold that I described to you. If you want to think about what 1 billion tons looks like, it's basically 1 kilometer laterally down to about 1 kilometer depth. That would be about 1 billion tons. And the scale bar that we have for that image that you can see in the lower right, that's about a 500 meter scale bar. So you can just see visually we've done more than enough to get there. And in respect of the high grade starter pit, that's maybe not so obvious on this slide, but if you look at all of the drilling, and we publish, when we put out drill results for this project, we publish the new drill results, but then in a table in the same release, we put all of the other drill results that we published. So we've got complete transparency when we're reporting our results. So you can see every hole that's been drilled here. And what you'll see in every single hole is that the highest grades are starting at the top of the hole, okay, which means that the highest grades are at surface and the lower grades are at depth. In an open pit mine, you start mining at surface in those higher grades, and then you work your way down over time. That's exactly the distribution that you need to have to give you one of these high grade starter pits. And that's one of the major differentiators when you're looking at this project that you don't see in other projects, okay? So that's the resource drilling. As I said, it's finished now. The central deposit remains open, so we'll still be able to grow it after that resource, but the resource drilling is done, and we'll publish the resource in the coming weeks. It'll be published in the first quarter. Okay, and then in respect of the second objective, where I talked about our goal of demonstrating that what we have in central can be duplicated in these other discoveries around the central zone. You can see that most clearly in the image on the lower left. And what you're looking at there, obviously the green is the topography, but then in the purple or the pink, those are the geophysical anomalies, which are reflecting the sulfide system. The copper is contained in copper sulfides. It's reflecting the sulfide system that hosts these porphyry deposits. And you can see the cluster of drilling at central just in the middle there, all the holes going into the central zone. That's the intensive resource drilling that we've done. And then you can see on the right-hand side of that image at Warintza West, I told you that we made a discovery on our first hole there. You can see that single hole, this first hole that was ever drilled into Warintza West. We actually didn't even have the geophysics at this time. We were just drilling it on 20-year-old geochemistry and mapping that had been done at surface. And we made a discovery there. We announced that back in February of last year. And then going the opposite direction at Warintza East, same thing, made a discovery, first hole we'd ever drilled. First hole that was ever drilled. None of these targets have been drilled outside of Central prior to our arrival. Made a discovery there. This was with the benefit of the geophysics, but it was on, again, the historical geochem. It's only recently that we've been able to go out and do additional geochem sampling to help refine these targets. And then most recently at Warintza South, this is just a couple of weeks ago, you can see this image. Same thing, made a discovery on our first hole there, entirely new deposit. Again, we had the benefit of the geophysics, but we were working from the historical geochem. We've added new geochem, and I'll show you in a minute how we're able to use that new geochem together with the other data from putting drill holes into these discoveries and the other data that we have to help refine the targets and get towards some higher grade zones and add value to those discoveries. Okay, so just shifting to the next slide, this is a bird's eye view. So you're looking down, you can see our central zone in the top middle. This is where we've drilled off the resource. So that'll be that plus billion ton resource that we're going to report. And then you can see the surrounding discovery. So Warintza West is on the left, Warintza East is on the right. You can see in terms of the dimensions, just in looking at the footprint of these, that they each have a similar sort of footprint as Central. Okay, and therefore, each of them, if we're successful in further drilling, each of them would have the potential to host plus billion ton inventories there. Okay, and there's no reason. We've made discoveries. We have 100% hit rate everywhere. In every hole that we've drilled, we've hit significant copper mineralization right from surface or close to surface. There's no reason to believe that we're not going to continue hitting here. It's quite the opposite situation. And then, as I mentioned, our newest discovery, Warintza South, same deal. This is down in the south at the bottom of the image. Same deal in terms of the footprint described by the geochem, described by the geophysics. The difference here that you'll notice is just the size. It's 2 to 3 times the size of our central deposit. And therefore it offers up similar sort of potential. The key for us in these discoveries is adding that additional data from the sampling that we've done more recently, using that together with the information that we got out of the discovery drill holes, together with the other information we have from the geophysics and mapping and so on, to refine the targets. Okay, so you've made a discovery. It's a multi-kilometer discovery. It's got multi-billion ton potential in the case of Warintza South. Now, where's the high-grade core of that discovery? That's a more careful, less drilling intensive, but higher impact kind of program that we're going to be working on going forward. Okay. And so if you just take in this full picture, you see the billion ton opportunity or inventory at Warintza Central. That on its own provides the underpinnings for valuation and an acquisition of this company. And I think because that resource is expected to be published in the coming weeks, the market's focused exclusively on that. And we haven't gotten credit for these adjacent and nearby discoveries. I think once that resource is published, becomes clear that this is a very robust economic opportunity, a multi-billion dollar valuation around just that Central development opportunity, then that's when people are going to begin to give us credit and take in these adjacent and nearby discoveries and the further potential to go from, plus a billion tons at Central to say 3 billion tons if you take in West and East, to maybe 5 to 6 billion tons when you take in the size of South, with additional drilling and so on. Okay, so just wrapping that up in the context of valuation and market implications and so on, you can see on this slide the range of estimates. There's about half a dozen sell-side equity research analysts that cover our company. You can see their estimates. Their valuations for our company are just based on Central. Okay, so they're not yet focused, because that's the next catalyst. They're not yet focused on the bigger picture. But certainly we would expect them to be after we publish the Central resource. And you can see the range of estimates there. They're anywhere from 600 million tons at the low end out to 1 billion tons at the high end. And they're getting into a range of $2 to $4 billion. Okay, in US dollar. We trade in Canadian dollars, bear in mind. But US dollars, 2 to 4 billion at copper prices with a consensus around 350 copper. Some of them are using lower prices. Okay. And that valuation, it's reflecting the things that we talked about. It's reflecting this being a robust deposit in terms of the grade profile, its size, the overall grade, but then the cost environment, it being a low cost CapEx and OpEx environment and a low tax jurisdiction that we're landing this project into. And it's that full package there in this jurisdiction, which is calling out for major mining investment. That full package is what I think, on the back of the central resource, is going to make this the most attractive acquisition opportunity on the board to the broadest possible audience of buyers. And in the mining space, you need to be available to Chinese buyers. Historically, they've been the most aggressive bidders. Obviously, they're restricted. You can't imagine a Chinese company building an open pit mine in the United States. It's not going to happen. It wouldn't happen in Canada anymore. They've ruined their reputation there as well. And it wouldn't happen in Australia, where they're, in a trade battle at the moment and restricting coal imports and all the rest of it. So the board's getting smaller for what has historically been the most aggressive buyer in the space. But Ecuador is still available to them as a jurisdiction. They're actually operating the largest mine down the highway from us in the country. Okay, so the impact of this, I think the only comparable, there's nothing really in the Canadian market that I can show you, but the only comparable would be in the Australian market, which is Chalice Mines. If you're looking for a precedent on, how we envision that resource being interpreted. And this is a company in Chalice Mines who they basically did for nickel what we're doing for copper. Okay, so they made a world-class discovery. When they published the resource for it, it quantified it, it established its credentials as such, so that people saw that there was a multi-billion-dollar value there, that it would be an inevitable acquisition target. And you saw their stock rally something like 40% off the back of that resource, okay, out to about a $3.5 billion market cap. And it's pulled back a bit since then. I think it's, just a bit under $3 billion at the moment. Okay, so that's the precedent for how we expect that resource. And then beyond the resource across the rest of this year, as I mentioned, we're going to be focused on making sure that we can demonstrate the further growth potential beyond the plus billion tons to 3 billion tons with West and East, to 5 to 6 billion tons when we take in South, so that we get the full value here surfaced. And you can see, even just in the value of Central, how much room there is to run to the upside before valuation starts to become a constraint on the opportunity from a stock perspective. Okay, so that's essentially the story. It's a world-class copper asset underpinned by Central. This will become clear with the resource in Q1, and then further with the discoveries around that. Very robust asset. It's in, I think, certainly a strategic metal, but probably the most strategic metal vis-a-vis these global megatrends that are underway. If you're talking about companies that are looking for scale, they can't find it in nickel, they can't find it in lithium. These are small, scrappy assets. They need these large copper assets. And then it's open to the broadest possible audience of acquirers. So with that, I think that's basically the story there. And then if you have any questions, I'd be happy to take those now.
Okay, Daniel, can you hear me?
Yeah, absolutely. I got you loud and clear.
Okay, great presentation. Obviously, you got a world-class project here. Got a few questions. Let me read one that was just typed into the chat box from one of our members. That what will it cost to fully develop the project? What would it take? How much money would it cost to get the first revenues, let's say?
The mine down the road from us, Mirador, which is comparable to our central deposit, that was built for about $1.4 billion. Okay, now there's cost inflation across this cycle. Okay, but call it less than $2 billion, and you wouldn't be wrong. Okay, now that might sound like a lot of money relative to a junior company, but remember, it's not our strategy to take this all the way to production. Our strategy is to stick to our knitting, stick to what's made us successful, stick to what's delivered $4.5 billion of exit transactions for our group in the last 10 years. And that's to surface the value through the exploration stage, and then to crystallize it and sell it on to a company that wants to take it all the way through to production. Okay.
Yeah.
So,
I mean, that makes sense for you, where your size is, unless you had to go out and, raise $1 billion or something. Yeah.
I mean, you could, like, if you look at Lundin Gold, okay, so they have the Fruta del Norte gold mine, which is just south of that copper mine that I described to you, Mirador. So they're about 15K further to the south of that. They actually went out and they raised not just $1 billion, but it was closer to it was closer to $1.5 billion to build that gold mine, and that was a single asset gold developer. Okay, in the way that we would be a single asset, or from the market's perspective anyway. We do have other assets, but primarily focused on one asset copper developer. So it's like certainly within the realm of possible. You could do it. It's just not what our strategy is. We've got to stick to our core competencies to deliver the best return on a risk-adjusted basis for our shareholders in the most rapid period of time, and that's what we're going to do. We're absolutely we're gonna do what we're good at. Continue to do what we're good at.
Yeah. So you're thinking this would be ready to be marketed, and then my question would be: are you just talking about marketing this one project, this one asset, and then you'd pay it out as all special dividend or something, and then go on to those other 4 or 5 project areas you have?
Yeah, absolutely. We in fact, it's a great question. I'm glad you asked it, because I skipped over this in my presentation. We were focusing on other issues, but we've already announced a spin-out company called Solaris Exploration.
Oh, okay.
And Solaris Exploration will continue the work that Solaris Resources has done as a successor company, and it'll take in everything surrounding this core development opportunity at Warintza, which is underpinned by Central, but will include west and east and south, and our Yowie target, which is our biggest target. I didn't even get a chance to speak about it, but that's our biggest target, the next one that we'll drill. That's a package there that suitable for any of the largest players in the mining sector. That's what you're looking at there is 100 years of mining. And so what we'll look to do in Solaris Exploration is take everything around that, which includes our next set of targets, some really attractive targets. You see them on the slide. Kaya is a multi-kilometer gold target. Mikey 1, Mikey 2 to the north of that. Our Clemente 1, Clemente 2 gold targets. These are large-scale targets. This is an incredibly rich piece of the Earth's crust here. If you actually look to the left of Warintza, so this is out to the west, you see entirely open land. And then you get across our property boundary out there. The Chinese have a 1 billion ton deposit of their own, sitting right there just across the fence line, which is called San Carlos and Panatza. That would be a future development option for them. But that area between the two, just hasn't been explored until we came along. And we're certainly very optimistic about the potential in that land. So we want to take basically everything beyond the kind of the core development opportunity at Warintza. We want to preserve that value in Solaris Exploration for our shareholders, and then repeat the exercise, surface that value in the successor company. Excuse me.
Yeah. So what you're doing is you're just proving up viable projects, and then going to sell them off to larger mining companies that have access to a lot more capital, correct?
Exactly.
Okay.
Exactly.
Hey, you talked about China's demand for copper. Does China have its own copper resources inside China?
They do. Yeah, they do. And they've been desperately trying to find new resources that they can develop. And they actually have a large scale development project in Tibet. It's obviously, some controversy around it, but that's called Julong, and it's a large scale development for them. But this domestic supply, including new developments, doesn't begin to reach the level that they require. So they are currently the world's largest importer of copper, and they will be for the future. There's no question.
Well, you got to have it. Yeah, you got to have it for all the electrification of everything. See, I think copper is viewed as like an old metal, like iron or something. It's not, as sexy as lithium or, some of these other metals that you hear talked about. But it seems like to me, it's maybe the most critical of the metals for the electrification of everything.
Well, I mean, you touched on a really interesting topic there. If you think about, how investors or how the mainstream media, for example, would consider these strategic metals like battery metals,
Right.
they'd list off, lithium obviously at the top of the list, and then you'd have, cobalt, graphite, and nickel. That would basically be the set and the extent of what they'd be talking about for critical metals to deliver on the ambition to electrify everything, as you put it, this electrification drive, the renewable drive, and so on. And that makes sense in the short term, and so you've got some of these metals that are in the kind of what I described as stage of the market of being a scramble for supply and a scarcity of supply market, where the prices are dictated by incentive pricing. Okay, and so you saw that most acutely in lithium, where it was up 450%, but cobalt was massively up, and you've seen the massive run up, multiple times run up in the cobalt supply earlier. The battery industry is actually trying to transition away from cobalt because it just became so expensive, away from graphite because of some of the technological advancements and so on, and indeed away from nickel because of the high cost as well. The nickel price has skyrocketed as well. And so some of the newer chemistries around LFP batteries, which is Tesla's standard for their lower range models. You don't see it so much in the US, but in their external markets and sales, it makes up a bigger portion. And certainly it's the future of energy storage because it's just so much less expensive. And so it's fair, for the moment where there isn't this kind of structural deficit or lack of supply of copper, to leave it off the list. But copper is absolutely fundamental to anything involving electrification.
Yeah,
it literally
anything.
is the wire, if not the motor, for anything involving electrification.
Yeah,
So there's no doubt that it's
there's
critical.
lots of copper in internal combustion cars. I mean, think about it. There's copper
oh,
wiring.
well,
There's copper wiring
look,
in every car.
In internal combustion cars, yeah, there's a lot of copper, but in EV vehicles, there's 3 to 4 times as much copper as there is in internal combustion. So copper is absolutely driven by these same dynamics. Where it reaches a critical point is, as I said, it's in late 2024, and then going forward, it starts to become, a gulf between supply and the demand. And this is really locked in because of the long lead cycle that we talked about. And that is when, if we were to come back and have this conversation in 2024, that is when we would be saying, now the mainstream media and Elon Musk and all the rest of it are acknowledging that copper is a strategic metal. That is when the price will be completely unanchored by the cost curve and is being pricing for scarcity. Where we're going to have $8 copper, $6 to $8 copper at least, and price spikes into the double digits to try and bring out this new supply. And it's not just price. Like, we talk about price and we focus on that. It goes way beyond that. If you look at the equity multiples, if you look at lithium companies now, like for US name like Albemarle or SQM trades in New York as well. It doesn't matter which, any of these lithium companies, you look at them, they're trading at 25 times EBITDA. Yeah. Copper companies right now, like Freeport, is trading at 5 to 6 times EBITDA. Okay, so 3 years from now, 4 years from now, when copper is seen as a strategic metal and Freeport McMoran is therefore a strategic company supplying critical metals into the supply chain for the country, for the United States and globally, to kind of achieve these, strategic transitions to electrification and renewables and all the rest of it. That it's hard to imagine that Freeport is going to be trading at much higher multiples itself. And so this is when, let me just take it back to when we're considering, valuation of assets. We're just looking at these assets as vanilla assets at the moment. To me, this is the bargain of a lifetime in the mining space, because you're paying a discount to a base a base valuation of an asset, which itself is going to grow. When the future is that these assets and companies are going to be revalued multiple times over, multiple times higher in the foreseeable future.
Yeah, I mean, I see the same
copper.
thing in oil and gas. I mean, I look at upstream oil and gas companies with great resource, their free cash flow today, and they're trading as if oil is going to be $50 or less forever. And here we are sitting with a $87 oil price today. So where do you see, okay, first of all, we've got some listeners that don't really know the copper, where it is today, but where are copper prices today? And then where do you think, even by 2025, which is just, 3 or 4 years from now, where do you see the copper price having to be to stimulate more exploration, I guess?
Well, copper is going to remain very firm in this kind of I would put it in a $4 to $6. Yeah, $4 to $5, you could say. I think it'll be higher than that, but it's going to be well supported here. We've got a bit of softening that we've just seen in the last month or so. This is driven by the Chinese Lunar New Year, and again, they're 50% of the demand side. This decrease is going forward, but they're still about 50% of the demand side. Over their holiday, they shut down 2/3 of their smelting capacity, and so obviously you get inventory builds across that period, and those inventory builds. This is a physical market. Supply and demand has to balance on a daily basis. So those inventory builds, they loosen up the market a bit, and we've seen a bit of pressure on the copper market. That ends mid-February, and you're going to go back across this full year. You are going to have deficits. Goldman Sachs would put it about 200,000 tons. Remember, this is after the supply scarring that we had in 21. Deficits came down faster than they have ever in the copper market last year to critical levels. So we're entering the year from an inventory perspective already at a low level. We're going to have deficits across the year. That's why I say copper prices are going to remain firm. But this is kind of still a normal market for the next 3 years, I would say. It's really only, or at least the next couple of years. It's only like late 2024 going into 2025 when it transitions into being a very different story. And that's when these structural deficits, take charge. And that's when copper, instead of being, an industrial metal just driven by, like the demand profile right now would be about 1/3 manufacturing and so on, about 1/3 into infrastructure, and then 1/3 into, building out home completions and things like that, and piping and all this sort of stuff. That's when it shifts to being all about electrification, all about renewables, all about EVs. And that's when the demand, really starts to take off. And the industry is just not in a position to supply it. And so that'll be a very, very different market dynamic then. And you can expect the pricing to reflect it. That's why I said, from 2024, 2025, somewhere in there, we're going to be in that range of $6 to $8. But boy, when the scarcity pinch points happen, it's a market that's got to balance supply and demand. So what's that incremental ton of copper cost? Could be into the double digits easily.
Yeah. Well, I make the quote all the time. I said, look, this world runs on oil, and nothing's going to change that until after 2030, and probably not then. It's the same way. When you look at the metal, this world also runs on copper. It runs on copper wire. Everything in your house runs on copper wire. So you got to have it, and it's certain at some point people are going to have to pay up for it. So that's it. It's the same way with oil and gas.
Yeah, absolutely. Both are true. Like, it's not like any of this is means that oil demand is falling. Quite the contrary. Oil demand is increasing.
Oil demand is actually increasing because of the renewable projects. You don't build windmills and solar farms with a Tesla. You build them with big equipment that runs on diesel. And so the demand for oil is going up over at least the next 10 years, I truly believe. And now we can switch a lot of stuff to natural gas, and that has why the natural gas market is growing so fast. But also it's not going away. And all the, on the mining side, I've seen projections that say to meet anything close to these projections on how many electric vehicles are going to be, we have to increase mining by 1,000% or 2,000%. has to be
Yeah.
increased to come up with the materials to make all this stuff. So
Yeah, but
yeah,
I agree with you about the challenge. Like as I
it's a
said
challenge.
in my remarks, like I don't know how it's going to get filled in. I don't know
I
how.
don't either.
Okay, so look, in the copper industry, we basically by 2035 we've got a double output.
Yeah. How's it
We've
gonna
got a
happen?
we've got a double output across the industry at a time where, you know, we don't have the projects in inventory. We haven't made the discoveries in the past decade that could feed into the development inventory. I don't know. I don't know. I just don't know. I don't know how it's going to happen. But in the short term, what we actually have in terms of, you know, this adoption of EVs is that it's beating estimates. Like if you go back and you look at the year ago estimates for what deliveries would have been across 2021, those were beaten by like 50%. And remember, that was with like the auto supply chain issues actually constraining deliveries. Like they're you know, that limited the deliverables in terms of EV units. So look, it's still accelerating. It's accelerating faster than people are forecasting. And that's only going to add to the challenge. I don't know how it fully gets realized, because as you say, the physical constraints around this are you know, are going to have an impact.
Yeah. Hey, I got like 2 more questions and then we got to end this.
Well,
But
please.
no, I don't like to go too much past an hour, but one of our members typed in, how much variability is there in the equipment you're acquiring and utilizing for your primary project, and how complex are they? Like how complex is the equipment you need to, I guess, develop the mine?
Well, look, the great thing about our project is it's an open pit. If you had an underground project, underground projects are, you know, like it's basically an order of magnitude. If you take the frequency of incidents and then the severity of incidents, they're as a measure of like technical complexity, like, you know, your ability to deliver it safely, they're about an order of magnitude more complex. An open pit is basically a shovel, which you just on a larger scale, like a you know, shovel, basically like a backhoe, if you think about that, but on a bigger scale.
But a giant one. Yeah.
A giant one, yeah.
A giant backhoe.
But it's basically a shovel feeding a lineup of trucks. And the trucks, again, are at a different scale. These are 200-ton trucks, and now there's 300-ton trucks. But that's it's as simple as it gets. And then the processing and everything. Open pit operations are really simple in terms of the equipment and so on. The only thing that you know, and this blows people away when they see one for the first time, is just the scale is difficult to take in. These things are absolutely enormous. Like the pit that we're talking about for Central, it's going to be multiple miles across. So a hole in the ground, multiple miles across, is the kind of scale that we're going to be delivering all this at.
Wow. Okay, one last question to say, remind us about your balance sheet and what is your capital budget for this year, and do you have enough cash on hand to fund that?
Yeah, look, we had 47 million at our last reporting period, US dollars, of cash on hand. And as I said, all the heavy lifting in terms of spend is behind us. So we're well funded with respect to what we need to do across this year. We haven't published the budget yet. It'll be coming at towards the end of Q1 when we report. But certainly spending plans well within the budget that you see there. And don't forget, we've got access to another, and this is shifting to Canadian dollars, which are, you know, 80 cents on a real dollar. We've got $82 million of warrants that are in the money, which are held by insiders and by our strategic supporters. We can call upon those if we ever need them in 2023 or whenever.
Okay, good. Well, we'll end it there, but I want to invite you back sometime. After you get the first quarter stuff announced. It sounds like to me that you're going to have a project that's going to draw a lot of attention for potential M&A. And then also, if you ever get down to Houston, we do have luncheons where you know, a lot of our members like to meet the CEOs firsthand, go from there. So anyway, I'll end it there. Thank you very much. Very great presentation, and exciting project you got there, and exciting near-term potential, looks like to me. So we'll be paying attention to it. So thank you very much.
Thanks so much for having me. I'd love to come down and do a physical presentation, maybe get some barbecue as well, or take
Sure.
in the cuisine that you guys have down there is very special, I know. So yeah, look, thanks for having me. I appreciate everyone on the line. Appreciate your time. Reach out to us if you want any more information. We're an open book. We love to engage with people. Yeah, anytime. Looking forward to it.
All right. Thank you. Sabrina, go ahead and end it there. And we will, this is being recorded. We'll send out a link to the recording to all of our members this afternoon.